Affordability is the buzzword making waves from Main Street to Wall Street to Washington. We're taking a deep dive into the real estate market. Welcome to our special Housing Crisis, the New Reality. I'm Josh Lipton. President Trump bringing housing front and center at the World Economic Forum in Davos, Switzerland.
In recent years, Wall Street giants and institutional investment firms, many of you are here, you've driven up housing prices by purchasing hundreds of thousands of single-family homes, and it's been a great investment for them. You know, the crazy thing is a person can't get depreciation on a house, but when a corporation buys it, they get depreciation. But homes are built for people, not for corporations, and America will not become a nation of renters. We're not going to do that. That's why I have signed an executive order banning large institutional investors from buying single-family homes.
The president's remarks come as Americans grow increasingly frustrated with the state of the market. Owning a home in the U.S. has long been a mainstay of the American dream, but high interest rates and ballooning home prices are freezing millions of people out of the market. Today, we're examining the key headwinds, what can be done to fix them, and whether owning a home actually still makes sense for you. Here to dive into why the American dream is underwater and what can help make the price right for Americans, let's welcome in now Rick Palacios Jr., the Director of Research at John Burns Research and Consulting. We got Danielle Hale, Chief Economist at Realtor.com, and Yahoo Finance's very own Claire Boston. Welcome to you all. Claire, I will start with you. And why don't we start on this issue, Claire, of affordability? Because you know President Trump, Claire, very focused on that issue. Talking about housing affordability, Claire, if I asked you to sort of compare, where we are now to, maybe 12 months ago, Claire, would you say we're better, we're worse, we're the same? How would you frame it?
Thanks, Josh. So compared to 12 months ago, housing affordability is somewhat better, but I think the key word there is somewhat. It is not easy at all to be able to afford a home. But a couple things have been helping buyers a bit. One of them is that mortgage rates are down almost a percentage point from a year ago, which helps make monthly payments a little lower. We are also starting to see home price appreciation slow. And what that does is it gives wages time to rise or sort of catch up, if you will. And that can also give buyers a better foothold into the market. But when you look at how much it costs to buy a home and what we consider to be a healthy payment, which is usually 30% or less of your monthly income on your housing payment, that is still really hard to find in most of the country at this moment.
Danielle, I'll bring you in here as the economist on the panel, Danielle. Affordability, you heard Claire there. Do you sort of generally agree with that framing of where we are?
Yeah, absolutely. We have seen home prices remain quite high, even though the growth rate has slowed. They still are quite high. We're getting some relief from the mortgage market for home buyers, but in general, housing payments are taking up a larger share of income. We do expect to see some relief, and in fact, our 2026 housing forecast anticipates that we will see that mortgage payment share of income slip below 30% for the first time in several years, but it's modest. We're going to be down in the 29% range. So it's not a significant step forward, but it will be a nice step forward.
Danielle, I have other economists on the show. We're talking about housing a lot, obviously, and they say, listen, what we should actually be focused on, Danielle, they say, is supply. You want to bring prices down, ramp up supply. What do you make of that?
Yeah, I think that is the right area of focus. I think it's easier from a policy perspective to get demand side policies across the line, but the supply side is where we really can make a difference from a policy perspective. But that's hard to do because a lot of those supply side fixes need to be done at the state and even local level, things like permitting rules, zoning, land availability. So it is a challenging road to approach, but I think that's where we would have the most effective results in the long run.
Rick, bringing you here as well. Danielle's making a good point. If you want to ramp supply, it's often a local issue. It's a state issue. Rick, are we seeing any movement there, any traction?
It's very slow. And on the supply versus demand conversation and where we need stimulus, I mean, I would say we kind of sit in the middle of the whole industry, resale, new construction. When we survey and talk to the 1,000+ resale agents we talk to monthly, 1,000+ home builders we're talking to monthly, they are not telling us that they need more supply right now. Actually, it's the exact opposite. Framing it from a home builder's perspective, home builders we talk to, they're telling us they got the highest unsold inventory since 2010, 2011. So supply is not the issue in the immediate term. They need some more demand, which I think brings us back to the affordability conversation. And where can we actually get rates down to? Because if you look at 30-year fixed rate mortgage today, we're at 6.2. So we've basically round tripped where we were before the 200 billion MBS additional purchase announcement. So we're kind of back to square one as it relates to mortgage rates.
Well, Rick, what do you make of some of the levers you see Trump suggesting, trying to pull? Mortgage bond buying, for example. Are these the right levers to pull, or should we think of be more creative? Are there other policies you'd suggest?
Yeah, I mean, I've always thought that the clearest and quickest path to improving affordability and really re-energizing demand is all about mortgage spreads. And we were actually already seeing significant improvement on mortgage spreads before the January 8th, I think, announcement with Fannie and Freddie buying an additional 200 billion. So there's been continued improvement there. A lot of that is just very macro driven. You don't have as much pressure on inflation. That's good for bond investors. You're starting to see more depository institutions come back into the treasury market. So these are all good things for mortgage spreads, but I think at the end of the day, we've made improvement on spreads. Now we need to get 10-year treasury rates lower.
Sticking with Trump, Rick, listen, we all talk about bringing prices down, but homeowner doesn't want his price to fall. I thought Trump's comments about that at Davos were interesting. He said here, Rick, I don't want to do anything, he said, that's going to hurt the value of people that own a house. You heard that. What did you make of it?
Yeah, so no, absolutely. So this is where he actually said something very similar to that. If you rewind the clock, December 18th, which was the day after the national address, when he was doing some Oval Office Q&A, this was a clear signal to us, and we actually got more optimistic on housing because of it, that the narrative on supply stimulus, the pendulum kind of switched over to, wait a second here, if we only focus on supply, we are going to hit price, and 65% of households own their home. We don't want the value of the home to go down. So that is where I think you saw this pendulum narrative shift to, wait a second, we don't want to just flood the market with supply. We got to start figuring out some tools and some levers in the toolbox to work on demand. So, and I think it makes sense too, because especially as you're kind of coming into midterms, the last thing you want, again, going back to 65% home ownership rate, last thing you want is for home values to continue falling in a lot of places, and they are, namely in Sunbelt markets.
Danielle, back to you. As an economist, you talk about the White House, some of their other policies, Danielle, front and center, and we talk a lot about this. So tariffs, immigration, how have those impacted the American housing market?
Well, in general, they are making it harder for builders to build. And so, that's driving up the costs for potential new home buyers. But I think thinking big picture about the supply of housing, we often talk about housing as if it's a national market, and it is a national market, but it's met with a lot of local variation. So we do have more abundant supply in the South and the West, where builders have been pretty active and able to boost housing supply. In the Northeast and the Midwest, we're looking at very different on-the-ground conditions. Demand is still relatively high in those regions, and they just haven't added as much construction over the years. And so the balance of supply and demand is very, very tight. So we're seeing home prices go up there, even as they're a little bit softer in the South and West. And our estimate of the supply gap, nationwide, it's pretty substantial. But the South and West have made much more inroads into closing that gap, whereas the Northeast and Midwest, in the Northeast in particular, we're actually seeing that gap widen. So housing is a very regional issue. There are these factors that affect the national landscape, but really there's a lot of work to be done at the local level.
Claire, there are viewers watching right now, and maybe they're thinking it's time to buy, they like to buy, and they're kind of debating, Claire, new versus existing. What do they need to know?
Yeah, so we are seeing some pretty interesting market dynamics now due to some of the reasons that both Danielle and Rick brought up. Normally, you would expect your new construction home to be a little bit more expensive than an existing home, which makes sense. It is new. But lately, that gap has been compressing. And this is really a story about builders being oversupplied in some of these markets. And so what we're starting to see is that they are really aggressively trying to court these skittish buyers. And they are offering things like mortgage rate buy downs, where they will pay to make your mortgage lower if you often use their affiliated lender. And that can translate to some real savings for buyers. We're also seeing them offer incentives, things like free upgrades or $10,000 to do whatever additional upgrades you want to do to your house. And in some cases, they are cutting prices altogether. They try to avoid this because it hurts people who already bought. But in this market, they're under pressure, especially in those southeastern and western communities. And that can translate to potentially deals for someone who's in the market in those places.
Claire, Danielle, Rick, great to have all of you on today. Appreciate it.
Thank you.
Thanks for having us.
Thank you.
Up next, while high mortgage rates are keeping many out of the housing market, Meredith Whitney says they are not the only problem. More ahead.
Mortgage rates aren't just calculated at random. There are two important parts that go into it. First of all, based on the financial markets, and second of all, based on you, the borrower. Let's break it down. First, the financial markets. Now, any kind of loan, a car loan, a mortgage, even corporate loans, they're all based on U.S. Treasury rates. That is U.S. debt, the U.S. government debt. And that trades in the market and changes based on several things. It changes based on the Federal Reserve setting benchmark interest rates, and then also what the market's perception of inflation is. Most people get a 30-year mortgage, so why is it pegged to the 10-year Treasury rate? Well, it's because in actuality, most homeowners stay in the home for 7 to 10 years on average. Inflation is sort of the silent force behind all of this because investors think inflation is going up will demand a higher rate on U.S. Treasuries. If they think it's cooling down, then they'll demand a lower rate. And then that feeds back into what you're paying for your mortgage. It also is why we watch things like economic data, like the jobs report or various consumer price reports, because they have an effect on the Treasury market. So that's the market part. What about the you part, how much you end up paying for your mortgage? Well, that depends on things like your credit score, how much you make, and maybe other debt that you're also carrying. The bank calculates how much more risky you are based on those various factors, and that combined with that financial markets rate, that is how your mortgage rate is calculated.
We talk a lot about interest rates when it comes to housing, but rates are only part of the story. Home prices remain stubbornly high, inventories still tight, and many older homeowners are choosing to age in place, keeping existing homes off the market. Yahoo Finance's Julie Hyman sat down with Meredith Whitney, CEO of the Meredith Whitney Advisory Group, to dig a little deeper into the growing affordability crisis.
The rates are part of the equation, but home prices are an equally, if not larger, part of the equation. So that really is the sticky point in affordability. So you can lower rates, but if prices don't come down, affordability still is very problematic. And there's another issue too, which is there's very low inventory and there's very low sales volume because they're a very low inventory. So 60% of existing homes are owned by seniors, people over 60, and they're not selling. So they're living in their homes for longer. They are aging in place, which means there's less property on the market and less inventory, churn, which keeps prices high. And the other thing that happens is that when seniors and homeowners are facing the same affordability issues that so many Americans are, they are increasingly tapping into the equity in their homes. So there's 36 trillion of equity in homes, and I estimate there's about 26 trillion in tappable equity. Only just over 400 billion is tapped today, and that's again very low relative to historic bases. So if you looked at 9 trillion of equity back in the where the housing crisis occurred, there was over 700 billion of home equity available. So the dynamics are not going to improve anytime soon. So last year, 2025, there was just over 4 million in existing home sales, and the estimates this year are a little bit higher, but not much. So I think the existing home market stays gummed up, and the fastest growing loan category is home equity. We think that there's a home equity renaissance going on, so that more and more people are going to tap into the equity to make ends meet. So increasingly, more people are using home equity as a cash management vehicle, whereas historically they've used home equity for home renovations. That's down. cash management is up. So you get into home affordability, which I think is going to be a central issue of midterm elections, and that's really going to focus then on new home building, and a lot of it then is going to focus on manufactured home building, because that is so much cheaper than the site-built homes.
Is taking money from your 401k to buy a home a smart idea? The growing debate over the possibility just ahead. President Trump telling reporters on Air Force One that he's not a fan of using your 401k to buy a home.
The housing market's good, but the 401ks are doing much better than the housing market. I like keeping their 401ks in great shape. I like keeping their 401ks. I'm not a huge fan of putting down in the buzz. I'm not. I'm so happy with the way 401ks are doing.
The comments come after National Economic Council Director Kevin Hassett said Trump would unveil a plan for 401ks in his speech at Davos when addressing housing affordability concerns. We took to social media to ask our followers on X their opinion on the topic. When asked, would you take money out of your 401k to buy a house, 51% of voters said it's not worth it. 25% said they would, and 23% said maybe. Well, President Trump pushed back on a plan initially floated by his administration to allow 401k borrowers to use some of their savings for a down payment on a home. So I have a retirement expert with me today to break down whether this is a good idea or a bad idea. Joining me now, we've got Gene Chatzky, the founder and CEO of Her Money Media and host of the Her Money podcast. Gene, it is great to see you. Let's start with President Trump, Gene, because it's making it clear there he's in fact not a fan, Gene, of using 401k plans for a home down payment. But what do you think, Gene?
I'm not a fan either, actually. And there are a lot of reasons why you should allow the money in your 401k to keep growing rather than using it to buy a home. When people think about using money from a 401k for something like this, they're most often talking about borrowing. And the argument that they make is, well, it's okay because the interest that I pay is actually being paid back to me. So it's a bit of a wash. It's not a wash because when the money is out of your 401k, you lose out on all of those years of growth. And when you're using the money for a home, most loans have to be paid back inside of 5 years. With a home, you have 10 years. And if you leave your job or if you lose your job, you're going to be asked to repay that loan very, very quickly, or it'll be treated as a withdrawal, which means if you're not age 59 and a half, you're going to be hit with a 10% penalty and you're going to have to pay taxes. And that can be incredibly painful.
So, Gene, let me ask you, though. So using a 401k plan for a home down payment, you're outlining there, listen, not ideal. But are there situations, Gene, you can imagine where it could make some degree of financial sense?
Look, if you've looked at all of your other options for borrowing and you've eliminated them, you don't have the credit, for example, or you are in a bit of a cash crunch, maybe it could make sense. A 401k loan is going to be a lot less expensive than many other forms of borrowing. And that's the argument in favor of it. But some plans prevent you from making new contributions to your 401k while you've got money out on loan. And that only further puts you in a hole for retirement. One thing we know, and President Trump rightly said, 401ks are doing great. They're doing really well, especially for younger people, because we've got all of these newer automatic provisions in place that automatically enroll people in plans, automatically escalate their contributions until they get to the point where they're maxing out. They move them into a target date fund so they're nicely diversified. All of these things are really important mechanisms to keep you on track for retirement. And if you pull that money out of your retirement fund and use it for another purpose, you're essentially just putting a monkey wrench in the whole kit and caboodle.
Jean, let's zoom out. Got a bigger thing question for you. I'm sure there's some viewers watching right now, Jean, and they're wondering, should I rent or should I buy? What is the smart way to think through that financial decision, Jean?
I'm a big fan of home ownership. I love the idea that when you get to the end of the road and you get to retirement, you will have something close to a paid off mortgage that provides you with another stash of cash that you can use for living expenses or other expenses in retirement. But you don't want to buy unless you know that you're going to be in that home for at least 5, maybe even 7 years. You want to make sure that you've got enough time to absorb the cost of a move, that you've got enough time to make the transaction work for you. And if you believe that you'll be moving within that window, renting can make sense. Renting can also make sense depending on where you're living, the housing stock in that area. It's a really tight housing market right now, and renting does economically look as if it's a better deal in some scenarios.
Jean, I'm sure there's some folks watching right now, and they want to buy a home. Right now, it's not realistic, but that's the dream. Long term, Jean, what are some smart, but also realistic tips to save for that dream? And are there also, Jean, programs that maybe you can tap into and leverage for that?
Yeah, 100%. So the only way to save successfully in my book is to save automatically. You set up a separate account for this down payment. You move money into it every single time you get paid. You bank your windfalls. If you get a tax refund, if you get a bonus, if you get money at the holidays, just move that money into that account and start watching it grow. Put it in a high yield savings account so that it is working for you at least a little bit. And then start exploring the first time homebuyer programs in your area. Many states have programs. The FHA has programs. The VA has programs. There is a lot of money out there that goes untapped for first-time homebuyers because they don't understand that they may be eligible for down payment assistance, for lower interest rate loans, and for a lot of other things that can help them get into that first home. The government is in favor of home ownership. That's something that we clearly heard and will continue to hear. But some of these resources are just far too unexplored right now.
Final question, Jean. If I'm looking to buy a home, in terms of time frame, would you say yes, now is a good time? Or for different reasons, Jean, you would say, you know what, better that you wait 6 months or 12 months?
Look, I think that's an interest rate question for many people. I think that interest rates are going to stick around pretty much where they are right now for mortgages. So if you're waiting, thinking we are going to go back to 4% land, we are not going to go back to 4% land. You are better off just figuring out what sort of home you can afford for the long term. Make sure you take into account the cost to live in that home, not just the mortgage payment. And once you find one that works for you, again, on that 5 to 7 year clock, I would say go for it.
Jean, so good to have you on the show today. Thanks for your time. Appreciate it.
Thank you for having me.
That is a wrap on our special Housing Crisis, the New Reality. Thanks for watching.